Good afternoon, everyone. My name is Suresh. We'll wait for the other participants to join. So we'll exactly wait 1.5 minutes. Then we'll start the webinar. Vishal, can we start the session?
Yeah, sure.
Yeah. Host and panelist shadow is an issue. On mute.
No, Suresh, we can hear you. You can go.
Yes. Okay. Hi. Good afternoon to all. My name is Suresh Kumar Reddy. So today I'll be the moderator for the webinar. So this is a part of the very quarterly update on the emerging opportunity portfolio. So today with us, Mr. Chetan Thacker, who is the portfolio manager of EOP, is with us. So Chetan have a very rich experience of about 15 years in the overall industry. So out of that, 9 years have into the equity research of the agricultures, chemicals and metals and mining. And previously, the Chetan has worked with the HSBC, MK and couple of reputed institutions in India. He is also a qualified CFA and the PGD MBA on NIMS. And he is there for the ASK from 2015 onwards. So participants, the Chetan will be covering about 15-20 minutes of the market outlook and about fund update. Post that, we request you people to post your questions on the chat box so that we will take into the Chetan. Over to Chetan.
Sure. Thank you, Suresh. Good evening, everyone, and thank you so much for joining us today for this webinar. As Suresh has highlighted, this is a quarterly update on the portfolio. The way we've structured this conversation is I'll briefly touch upon the market update. I'll cover the changes of the portfolio and how the portfolio has performed in the last quarter in terms of earnings. And we'll then open the floor for question and answer session. So just to begin with the market outlook, I think what has happened in the last quarter very clearly is that we've seen some abatement of inflationary pressures globally. That has played out not only in the US, but we are seeing some early signs of that play out even in a large part of the developed markets. What that has meant is that we've seen quantum of rate increases from US starting to moderate. We've seen a 25 BIP increase last time around from the Federal Reserve. We've just seen the MPC getting announced by the RBI today, and they've continued to hold on to the rates in light of the slowing inflation. As you can see from this slide, in terms of inflation graph, in terms of the domestic inflation, as we have been highlighting for quite some time, that most of the inflation that we witness in the country is largely driven by imported inflation, which was driven by higher energy prices, which was driven by a lot of supply chain issues. A lot of them have started to get resolved as China has opened up. Starting January, we are starting to see moderation in supply chains. That has led to inflation abating. We've seen crude oil prices come down. That is also helping in terms of moderating the inflation as far as the Indian economy is concerned. In light of that, now we've seen two monetary policy meets where the rates have been kept stable and they have remained unchanged. Our expectation is that we've probably seen the peak of inflationary pressures here, and after a period of probably pause a tad bit higher rate, which will also depend on how the Federal Reserve behaves going forward, we can expect rates gradually to then start moderating as well, which should provide an added fillip as we move forward into FY24 and FY25. As highlighted, we are seeing commodity prices across the board correcting. A large part of this reason is that in January of this year, there was an expectation that as China opens up, we will probably see a lot of pent-up demand that comes in, which meant that commodity prices would have got support. We saw an initial rally as far as commodity prices were concerned. However, after the opening up of the Chinese economy, we've not seen demand which has been very strong, which has meant that commodity prices have started to moderate. We are increasingly seeing and listening from the managements that there is fair degree of inventory in the system in China, which is also getting exported out, which is additionally cooling off the commodity prices across a variety of commodities. As far as oil is concerned, which is a big import bill for us and which was a primary reason for our inflation starting to inch up, we've actually seen oil prices start to moderate. We've seen oil prices move down back to the $70-$75 per barrel mark, and they are stable around that, which is also providing an added fillip as far as the inflation from the energy basket is concerned. On the supply chain normalization, I think this graph depicts it very well. We were at a peak of supply chain issues at the time of COVID, particularly the second wave of COVID. That is when we started to see a lot of supply issues leading to sharp increase in freight cost. That essentially meant that inflation in a way was also getting stoked by the supply chain bottlenecks that were visible across various parts of the world. Not only in China, we were witnessing the same thing playing out probably in US and certain parts of Europe as well. It got to some degree complicated more by the war that we witnessed in the early part of last year. But what we witnessed now is, particularly since China's opened up, we've started to see a sharp moderation as far as freight costs are concerned. They are a good depiction of how supply chain issues are getting normalized globally. And this should also add to taming down of inflation globally, not only in India, but also in the other parts of the world. As far as agri-commodity prices are concerned, while they continue to remain elevated, they are off their peaks. That also provides an added leg as far as the commodity basket is concerned. As far as the domestic commodity prices are concerned, particularly on the agri side, there is obviously a development that has happened last evening. We've actually seen MSPs being increased for the upcoming Kharif season. While on one end, it can add to inflation to a certain degree because these are large increases that have been passed on by the government to the rural sector. What this also does is that it provides an added income to the rural economy. That part or that segment of the economy has been struggling for quite some time, particularly post the second wave of COVID, when a large part of the savings were impacted on the rural side. And we've actually seen the rural income take a hit, which in turn has meant that rural demand has continued to remain sluggish. With the increase in MSP, the expectation is that you will start to see recovery and revival, which starts from the rural side as well. Albeit there will be some degree of inflationary pressure that will be added on the food side as we move along into FY24. Coming to the flows, I think this is a big part of the story. A large part of last year witnessed a lot of outflows. If you can see from the first column on India, we actually practically saw outflows which started from October of 21. They continued to a large effect till June of 22, and then it was patchy all the way till January of 23. Especially from March, we've actually started to see stabilization. Feb was a month of stabilization. Then we saw March where inflows started. May has been a good month as far as inflows are concerned. Inflows from the FII side also provide significant liquidity to the market, and that has been one of the factors which has driven the recent rally that we are witnessing. Coming to the DII participation, the SIP flows, which have kept on inching up gradually ever since COVID hit us. We are actually seeing SIP flows continue to remain very stable, upwards of 12,500 crore. That has continued even in the months of February, March, and April. They continue to remain strong. We have actually seen structurally DII participation, which essentially means that the retail or Indian domestic participation in the markets continue to improve and remain strong. This is one structural shift that we have been witnessing, financialization of savings game scheme. We are seeing a benefit of that flowing through on the equity side as well. Coming to the EOP portfolio, this slide talks about the earnings growth, like we've been highlighting for quite some time. in our monthly commentary and also in our last interaction during the quarterly call. What we have witnessed in Q4 is continued normalization of operating profit margins. If you recall, the first half of last year was essentially a period where we witnessed sharp contraction in margins because of the volatility of underlying commodity prices that we witnessed. Normalization of those margins started from Q3 onwards. That has also continued in Q4. While on a demand volume side, what we witnessed as far as the earning seasons is concerned is that, like we've been highlighting, there is fair degree of tepid demand from the rural side, which has kept volume growth under pressure. Most of the leading companies have reported close to single-digit kind of volume growth, which essentially is a function of weak rural, while the urban continues to chug along as far as the recovery in demand is concerned. Having said that, Q4 FY23 would have been a story of margin expansion and normalization. We've seen that play out. Our portfolio operating profit growth in Q4 was 22% as compared to the Nifty 50 operating profit growth of 12%, while the PAT growth was higher at 25% for our portfolio. For the Nifty 50, it stood at 16%. What is interesting is the FY24 and 25 picture. FY24, which is the bottom table, herein we expect operating profit growth to remain strong at 26%. There are two parts to the story. One part is essentially driven by the fact that we continue to believe there will be normalization of margins that we witnessed in Q4. We'll see that continue all the way through FY24. The first half of FY23 had a very adverse base that will essentially help in operating profit growth in H1 of FY24. While on the volume side, we are keeping a very close eye. There are two drivers to the volume growth. One driver is the entire capex spend that we are witnessing, and we are continuing to see a strong tailwind there, which is very clearly visible from the high frequency data. It's visible from the data such as steel consumption, cement consumption, which is up anywhere between 7 to 10%, which essentially tells you about the investment and capital formation activity that has been ongoing in the country. We believe that the higher capex which the government has announced in the budget will provide a fillip as far as the volume growth is concerned. The second piece of the puzzle is obviously what happens to monsoons. I think we are seeing varied reports of monsoons which have come not only from the private forecasters, but also from the government forecasters. There is an expectation that monsoons might undershoot the long-term average, but we will keep a close eye there. It's also the spatial distribution of monsoons which is more critical. One big fillip that has happened, like I was highlighting last evening, is an increase in MSP. That means that even if yields are lower, we can probably expect better agriculture and rural incomes, which should provide the recovery as far as volumes are concerned from the rural side. The third bit of the puzzle on the volume growth is the entire exports bit. Exports also, similar to the domestic market, went through a rough patch as far as FY23 is concerned. Given the sharp increase in cost of capital globally and the fact that inflation had become too sticky in a large part of the developed world, which got more complicated with the higher energy cost, what we witnessed was destocking of the channel across a lot of industries globally as well. That has meant that FY23 had a very adverse base as far as exports growth is concerned. We can see that not only in sectors such as chemicals, pharmaceuticals, but we saw an impact of the recessionary fear also in pockets such as the IT services space, where budgets have either been tweaked or they have been moved out, pushed out, while projects underlying have been also seeing a change in character of the projects. So we have a very adverse base as far as the exports are concerned. Going forward into FY24, our view is that you will start to see some degree of restocking that will happen. We are probably still a quarter or two away as far as that restocking of the channel is concerned, which should provide the first leg of recovery on the exports front, post which it will essentially be driven by how cost of capital behaves over a more medium to long term. Our view there is that after a rate hike cycle there, once inflation seems to be under control, we will again see, similar to what we are witnessing here, that rates will go through a period of plateauing out, post which there might be some downward tick as far as the global cost of capital is concerned. That should help to revive demand, which means that FY24 second half, FY25, we will start to see positive contribution starting from exports as well. So the 26% operating profit growth assumption for the portfolio as a whole builds normalization of margin. It builds some degree of recovery on the rural side. It also builds some degree of recovery from the export businesses that are there in the portfolio. Given the adverse base of 23, we see a higher degree of operating profit growth of 26% in 24, post which we move to a more normalized portfolio earnings growth of 22%. This chart depicts the Nifty valuation. What we witnessed was that there was compression in valuation, particularly since the last 1 year. We are seeing some degree of bounce back as far as the valuations on the Nifty are concerned. As far as Nifty earnings growth, this chart depicts the Nifty earnings growth. The earnings trajectory improvement is driven by a lot of factors. It is driven by the fact that the financial contribution of financials within the index has started to turn positive. That is also driving some degree of earnings growth to the benchmark itself. We are also witnessing margin expansion again in FY24. It was a phenomenon not only for our portfolio companies, but it was a broader phenomenon, and that is also playing out and is expected to play out. And hence, you see a higher degree of profit growth between 23 and 24, and that we expect will sustain in 25. As far as the portfolio positioning is concerned, we had talked about this last time. What we've done in the last quarter is you would have witnessed that we have deployed some degree of liquidity that we had created in the portfolio. We have added exposure to the financial sector. We've added weight to the banking space within the portfolio. That is where the weights have gone up. Consumption still continues to remain our overweight position. The view there is that as per capita income goes up, you will actually see contribution or the opportunity size for particularly the discretionary part of consumption to participate in the growth going forward from a more medium to long-term perspective. So we continue to remain overweight on consumption. The second theme is manufacturing from India, for India, and out of India. I think India has now formed a firm place as far as an alternate destination for manufacturing is concerned. We have seen a lot of policy support being rolled out there in the form of PLI schemes. What we are witnessing is that while structurally things are moving in the right direction, structurally we are seeing an improvement in FDI inflows, which clearly points towards India emerging as a manufacturing destination. The India market share in overall global exports is minuscule. Hence, there is an opportunity for India to gain market share there, which in turn will not only drive employment, it will also drive GDP growth from a more medium to long-term perspective. What we are dealing with in the more near term is the fact that a large part of the developed world is going through a period of moderation of demand, while structurally we are seeing steps that have been taken starting to bear fruits. We are actually seeing capex intensity improve. We are starting to see a lot more conversations across companies and sectors where India is being looked at as an alternate destination for manufacturing. So investments continue there in this pocket, and our expectation is as the demand environment gets more clear and as the clouds clear off as far as global demand is concerned, this should start to contribute in a meaningful manner, not only for the portfolio, but also for growth in general. That is one pocket where we continue to remain overweight. Our overweight position in chemicals stems from that to some degree. The overweight position, which is sitting within the consumption basket, also has a play which plays out as far as the manufacturing base of the country is concerned. We have added some weight in the pharma side. So there are a couple of stocks that we've added during this quarter into the portfolio. We've added an IndusInd Bank to the portfolio. We've added Alchem Lab to the portfolio. We've added certain more names to the portfolio, particularly on the consumption and consumer discretionary side. Going forward, where we still see scope of addition, where we are still underweight, as you can see clearly from here, is that we still remain underweight in automobiles. That is one pocket where we continue to evaluate opportunities. If found fit, you will probably see us taking certain actions there. Healthcare is another pocket where we believe that there is an opportunity to increase weight, and at an opportune time, we will go ahead and deploy more monies in that particular pocket as well. As far as the portfolio psychography is concerned, we've covered one bit of that in the earnings growth profile. What this essentially depicts is that the ROC of the portfolio continues to remain superior. We continue to populate the portfolio with high quality, high growth companies. The ROC is upwards of 30%. What is interesting to note is the valuation ratios. We have witnessed compression in PE in FY23. That is a function of the fact that while operating profits grew by close to 18-19% for FY23 as a whole, what we witnessed is that the portfolio corrected in that particular year. That has meant that the portfolio valuations have moderated and they've become relatively more reasonable. We are seeing that in the PE ratios of the portfolio as a whole, where the PE ratio has compressed to 24 and 20. Our firm belief is if our portfolio companies can deliver on the earnings growth which we expect them to deliver, you will probably also now witness some degree of tailwind as far as the valuation is concerned as we move ahead from a more medium to long-term perspective. This is the long-term performance of the EOP companies. A thing to highlight here clearly is the quality of the portfolio, which is depicted by the 31% average ROC for the portfolio and 20% plus PAT growth. Our endeavor continues to remain to identify names which are high quality and high growth with a bias towards mid caps and populate the portfolio with these names. The expectation is that if our companies deliver on our earnings expectation, you will see returns that will follow as far as the performance is concerned. This is a snapshot of the performance. What we witnessed in FY24 YTD is some degree of catch-up that has happened in this period versus the BSE 500 benchmark. We are seeing some degree of reversals compared to the underperformance that we had witnessed in FY23. We have deployed a fair degree of the liquidity in the portfolio. There is still some scope for that liquidity to get deployed. But our expectation is that we are done through a large part of the restructuring of the portfolio that we wanted to achieve. Going forward, while we'll continue to evaluate names in our universe set, we'll continue to evaluate names in our portfolio which will need tweaks and adjustments. Improve the portfolio psychographics overall. When we say improvement in portfolio psychography, we typically mean either we try to improve the earnings character of the portfolio, or we try to improve the quality of the portfolio, which is depicted by ROCs, or we try to reduce the risk in the portfolio. An ideal situation is either we get a combination of these, or the best case situation is if we can identify names which fulfill all three criteria together. So we'll continue to evaluate names in our universe set and continue to make changes where we believe are relevant from a more medium to long-term perspective to improve the overall character of the portfolio and quality of the portfolio. That's it from our end as far as the presentation is concerned. I'll open the floor now for question and answer.
Thank you, Chetan. Participants, we request you that whatever the questions which you are there in your regarding to your portfolio, request you post in the question box and our chat box. In the meanwhile, from the Chetan, we have collected some of the questions. So I would be asking to you so that will help with all the response. Chetan, we have been observed that from the month of April to till now, the good recovery has happened about 11% of the portfolio. Can you just explain and which of the stocks has been contributed for this performance? And are you done any changes in the to do performance to recovery of this performance? That's the major question which is coming from the customers.
Sure. So just to begin with your second question first, like I highlighted in my presentation, we made certain changes to the portfolio. We've added some degree of weight on the financial side. We've added some degree of weights on the healthcare piece as well. That is where we've seen some increase in weight. We've added weights on the consumers and consumption discretionary side as well. We've increased weights there. If you recall, I think a large part of the last 3 to 4 months, we had liquidity in the portfolio, which we started to deploy. We've taken our time to deploy that liquidity so that we identify names which are more structural from a medium to long-term perspective. They fit our philosophy of high quality and high growth. And that is where we've deployed this liquidity into the portfolio. As far as the performance is concerned, what I'll touch upon is not the performance itself, but the underlying reason for that performance, which is what we firmly believe. We believe that performance will typically come from the underlying earnings performance of the portfolio. What we witnessed is a strong earnings performance in Q4. There have been certain names which have delivered significantly better as far as our earnings expectation and street's earning expectation were concerned. And we've seen contribution coming from those pockets. Financials is one which stands out as far as performance is concerned. They continue to deliver what we expected them to deliver, but we've seen a better performance in market price there. Where we've seen a significant beat as far as the earnings performance is concerned is particularly the twins of Polycab and KEI Industries. We've seen strong performance from our chemical exposure also by way of better than expected performance from something like a Naveen Fluorine in the portfolio. So all these factors together have essentially contributed to the underlying strong earnings growth. What we see is some degree of cognition of that same strong earnings growth flowing through as far as the performance. So our expectation from a more medium to long-term perspective is if our portfolio companies deliver on the expected earnings performance, I think performance will follow.
Okay. Chetan, there is one common question which is coming. The EOP EOF, which is almost the customers, some of the customers have invested 2 years back. The portfolio values is exactly at the range between a 0 to 2%, or some of the clients are -1 to 2%. So their question which has come is, it's been 2 years has been done now. So is there, how can we look forward the next 3 to 4 years? If I stay back over the 5 to 6 years overall the portfolio, what type of returns I can expect to the, if I stay back into as per the desired period of 5 to 6 years as an overall portfolio?
Coming to the underperformance, particularly on the EOF front, I think FY23, a fair degree of underperformance for the entire portfolio itself was driven by our exposure to the financial names. When we say the financial names, what we witnessed in FY23 is what is of importance to get into the context and to understand why that underperformance has happened. What we witnessed in FY23 is the fact that because of the rate expansions of RBI, what we witnessed was a faster normalization of ROEs for banks in general. That essentially meant that a lot of banks which were struggling as far as their asset quality and ROE is concerned, they saw a twin benefit of not only higher loan growth, which happened because a lot of money moved from CP/CD market to the banking channel, because the CP/CD market typically factors in the rate hikes upfront as compared to the banking system itself. So we saw some degree of growth getting to the banking channel as compared to the other part of the capital market. That meant that loan growth was strong. In a rising rate cycle, what typically happens is deposit rates get repriced after a lag, and hence we saw NIM expansion that happened, which flowed through all the way down to ROE. We also witnessed provisions or credit costs which were lower than the long-term averages, which was a function of credit growth being very tepid in 2 years previous to FY23, which meant that there was an ability for a lower credit cost. All of these factors together essentially meant that the part of the portfolio where we were not present, that witnessed a performance which was better than what we owned. Having said that, what we had in the portfolio, while it delivered on our earnings expectation, we saw the Bajaj twins deliver as far as our earnings growth expectation is concerned. Bajaj Finance ended the year at 65% earnings growth YOY. While per se, prima facie, those names would have delivered on earnings, we've seen some degree of money movement, which has happened from the pocket that we owned to the pocket where we were not present. We have taken certain corrective actions there. Like I was highlighting, we've taken some degree of weight increases as far as financials were concerned. However, overall, our longer term view on that particular pocket or that particular space is that post this period of normalization, the discussion and focus will shift back to the most common phenomenon of evaluating these businesses, which is getting all the three matrices right, which is asset quality, which is growth of the business, getting that equation right. And that is where we believe that the names that are there in the portfolio stand out from a more medium to long-term perspective. The expectation is, as you start to see earnings delivery continue in that pocket, as compared to the other pocket where growth itself will be limited by the ROEs of those businesses, you will actually see market again re-looking at these names where the ROEs are sustainably and structurally higher, which supports a higher growth from a more medium to long-term perspective. So the expectation is that there will be some degree of adjustment that will happen there, and you'll start to see performance improve there. The second part is obviously there were certain names in the portfolio which were dragging performance. We have exited out of those names. What we've done is we've added new names in the portfolio. KEI Industry is a part of that change where we've added that name into the portfolio. We've also added Naveen Fluorine in the last 1 year into the portfolio. Recently, we've added Alchem Labs to the portfolio. We've also added a few more names on the consumer discretionary / logistics side, where we believe there is a strong structural tailwind. The expectation is with earnings delivery being in line with what we expect, you will see performance to get reflected in that. We've seen some early signs of that starting this year. Our expectation is that with earnings growth continuing to remain strong for the portfolio, you will start to see that opening up as we move ahead as well. Having said that, there are still certain pockets where we believe there is an opportunity where we are underweight, and those are the pockets where we continue to evaluate names. That is what I touched upon while presenting in the first part. There is an opportunity which is out there on the automotive space where we are underweight. So we are looking at names there. There is an opportunity still on the healthcare piece where we are looking at names there. Whether we can do something there. Capital goods is still underrepresented in the portfolio. So we are seeing that if there is a possibility to participate in some of the names which meet our criteria of high quality and high growth. So all these changes that we've done in the last year and a half, should ideally start to reflect in a stronger earnings growth. Last 1 year, while earnings growth remains strong for the portfolio, it's the underperformance which has also meant that there has been a compression in valuation. Our expectation is you will see some degree of tailwind that starts to happen from there, as well as we move ahead and the entire inflation debate starts to settle down and we start to see some degree of moderation in rates.
Thank you, Chetan. Chetan, one common question which is coming, we have recently added 3 stocks. One is Go Colors, TCA Express, and Alchem Lab. So most of the participants would like to know why, in terms of at the moment we have added the 3 stocks, and in that, and TCA Express, the people are asking if we have a Gutty, we have a Blue Dart and other names, even though why you selected of these stocks.
So I'll just touch upon TCI Express to begin with. If we look at India from and if we zoom out and we look at India from a more competitive landscape as far as exports and manufacturing in general is concerned, there is a big bottleneck, which is the logistics cost in the country. The logistics cost in the country today still continues to remain very high, which is closer to 11-12% of GDP. Globally, in a very competitive country, it should be in the range of 7 to 8%. That is the target which the government is also working with. The entire roadmap of Gati Shakti is based on the fact that you have to improve logistics efficiency in the country, because logistics efficiency also plays through as far as the cost competitiveness is concerned. So whatever projects that we are seeing are rolled out either in the Gati Shakti mission or which are being rolled out in the Sagarmala mission of the government are essentially geared towards ensuring that logistics cost as a percentage of GDP goes down. You see a reduction in bottlenecks. We've seen some degree of benefit happen because of GST, but the full benefit of GST can only come through if the entire logistics and distribution channel is well placed and competitive and at a very competitive price. As far as looking at players within the sector is concerned, yes, there are various opportunities that are sitting there. The reason why we like TCI Express is because of its asset-light nature, which provides a higher ROC to this business. They cater largely to the SME and the manufacturing space, which is where we believe that you will see strong tailwind of the entire manufacturing story of India also play out. Hence, they are right placed as far as that pocket is concerned from an exposure point of view. If we club all of this into the macro, our expectation is that TCI Express has the right business model sitting in the right space to explore the faster growth that is expected from there. Within the entire logistics and warehousing piece, if you were to look at that piece altogether, what you essentially witness is warehousing is an asset-heavy piece and an asset-heavy business. Even on the logistics side, you can have 2 models. One is either you own these trucks and fleets on your book, which makes it a very asset-heavy model. Then you can have a model wherein you essentially aggregate a lot of these players and providers onto your platform and efficiently move things within the country and cater to your customer needs, which provides a combination of an asset light model and a higher growth. And hence, that is where we believe that TCA Express scores, and we've taken some degree of exposure there as far as TCA Express is concerned. Coming to Go Colors is a predominant player as far as the women bottom wear market is concerned. They are leaders there. What they've essentially showed and depicted is that they have a right kind of economics as far as the entire retailing piece on the women segment is concerned. They are a very focused player as far as the bottoms is concerned. They are focused today on women and bottom wear. They have gradually over a period of time expanded their SKUs. They've got the model set right, and they are now geared towards expanding their network within the country after having the model set right within this space. We believe this is a segment which has not only a value proposition which is there to the consumers, because the consumer there, as the value proposition there clearly is large number of SKUs and quality of product. So it is probably something like a page some time back where they had a right consumer proposition in terms of the product being right for their customers. That is where we believe Go Colors has a right product for the customers. They have a right model to provide capital efficiency also, while keeping a higher number of SKUs and catering to that segment. That segment itself is also witnessing a fair degree of increasing spending power. We believe there is a strong support of demography. As we spread the picture out over the next 10, 15, 20 years, our expectation is women participation in the labor force will continue to increase. Women spending power by women will continue to increase as they incrementally start to become bread earners within their households. And that means there is a large segment which they can cater to. Not only does that provide an opportunity of increase in volume growth, it also provides an opportunity for premiumization within that entire bucket. And that is where we've taken some degree of exposure as far as Go Fashion is concerned. Coming to Alchem, Alchem is a predominant domestic pharmaceutical player. What we witnessed in the last 1 year were twin effects. One was obviously a normalization of top line growth because of a very high base coming off COVID. COVID has essentially meant a very high base for FY22. So FY23 was largely a period where you saw most of these names getting impacted by one, slowing volume growth because of the base. Second, the entire increase or volatility in commodity prices meant that margins were also under pressure in FY23. Our expectation from Alchem is that it will continue to deliver growth higher than the IPM growth for the domestic market. There is a margin lever which is there at play, which can play out as well in Alchem. And we believe they have a strong domestic leadership as far as the pharmaceutical space is concerned. And that is where they are rightly placed to essentially benefit from the structural growth on the pharma side, while having a lower degree of volatility from the exposure which we witnessed for a lot of companies which had exposure on the regulated markets because a lot of issues that have been there relating to the regulatory tailwinds plus the entire price erosion issue.
Thank you, Chetan, for the detailed explanation on each stock. Mr. Vipul Shah is asking one question. By looking at the EOP portfolio, it's look more of the large cap stocks, but the name represents the emerging opportunity portfolio. So why is it so? So what would be the answer for that?
So as far as the portfolio is concerned, I think 25% of the portfolio is large caps. It is still 70-75% which is mid to small caps. When we say mid caps, it's obviously largish mid caps and not the smaller mid caps. There is a conscious effort to ensure that this remains a predominantly mid cap portfolio. If you were to look at the changes that we made to the portfolio, most of the changes have been on the mid cap side, and that is where the exposure has been added. And we firmly believe that as GDP growth starts to accelerate, the markets continue to broaden out, we will see a lot more opportunities to participate on the mid cap and small cap front. We have started to add weight there. That is where the liquidity which was sitting in the portfolio has been deployed. We are very cognizant of the fact what we deploy in large caps also have a role to play. If you look at large cap exposure, the reason why the large caps are there is there are certain sectors and pockets where scale itself is a big differentiator and a moat, something like financials, where you need a scale in order to remain competitive and deliver value to your customers. That is where a large cap exposure is. You have some degree of large cap exposure which is there on the IT side. Again, it's a scale business. We have just one name there, but it is on the large caps front. So the large caps that are there in the portfolio are largely in pockets and segments where you typically need scale benefits to compete in those pockets and segments. These are pockets and segments which we believe will continue to drive the emerging theme. When we say emerging opportunities, it's more emerging opportunities from the point of view of the opportunities itself and not specifically to the market cap of the entities and names. So if you look at manufacturing in general, what we are witnessing is people with strong balance sheets are essentially deploying more money there, and they are capturing a larger pie of the opportunities that is available even under the PLI scheme. If you look at the other emerging trends, where we believe that there is a scope to identify a name, something like a Go Colors or a TCI, which are classic mid caps, which have a strong tailwind and a right business mix and right business proposition. we've taken exposure there. So even in the mid cap index, there is close to 20-25% weight of large caps within that index. So we are similar as far as the mid cap weightage is as far as the large cap weight in the portfolio is concerned. But there is an endeavor to ensure that the names, when we add to the portfolio, we are very cognizant of the fact that this is a mid cap and small cap portfolio. And there is an endeavor to ensure that we populate the portfolio from that particular market cap.
So there is a very interesting question, so which has come from the one of the participants. So the markets are at the all-time high, about 63,000 of thing. So considering of these situations of the GDP growth is happening and the macros are looking very good. So is it the right time to add the money into EOP portfolio? What's your advice?
So like I've been highlighting, I think from a more medium to long-term perspective, we are very clear that structurally things are placed right as far as India is concerned. That is to do with the reforms that the government has pushed through, not only recently, but they have pushed through in the last 6 to 7 years as well. That has provided a very strong foundation as far as growth is concerned. We are, after a length of time, seeing manufacturing getting its due recognition, getting the due policy push and support from the government. The idea of all the schemes is to ensure that there is a fair degree of time period provided to the Indian entities, which provides them the ability to scale up and compete globally and not only in India. That is one pocket where we have witnessed that the share of GDP contribution has kept on inching down. But our expectation is, coupled with the government initiative plus the strong tailwind globally of people wanting to move supply chain away from China, I think India is rightly placed there to capture that kind of opportunity. Services, I think India was always, services sector has been a torchbearer for GDP growth. We continue to believe that will remain the case as we move along as well from a more medium to long-term perspective. Agriculture is one piece which has seen a lot of volatility, particularly related to weather. That in turn has meant there is a volatility on rural incomes itself. That is where we are witnessing fair degree of sluggishness. So from a more medium to long-term perspective, we believe the foundation is firmly in place. What we are also internally monitoring is we are monitoring how volume growth shapes up as we move ahead. I think the entire MSP increase bodes well as far as that rural piece of the puzzle is concerned, which has been witnessing moderation in demand for quite some time. Our belief is that should start to accelerate. So from a more structural to a long-term point of view, yes, India shines out particularly. The idea is that as growth accelerates, you will start to see performances also improve here. The risk that we see to the portfolio and in general is, one risk clearly is if you have a very adverse monsoon, that will mean that this volume recovery that we expect on the domestic side might get pushed out again because of the weakness that we are witnessing on the rural side. The second risk that we essentially foresee is more from a global macro point of view, is that if interest rates continue to sustain higher for a higher length of time, there is some degree of risk that opens up globally in pockets which we are unaware of. We've seen one episode of that happen in March, particularly on the banking space in the developed world. So our view is that that is a second risk that is there from a more macro perspective. So going forward, while we believe there is a tailwind of acceleration in earnings growth, I think what we are keeping a close eye on is how the monsoon plays out very clearly in terms of spatial distribution, because that to some extent will determine on how volume recovery happens.
So there is a two markets, that urban market as well as the rural consumption market. So many shares in the EOP portfolio is shown as an urban bias portfolio. So what's your view on the why so like that? Are you looking into the rural consumption story also?
So essentially, when we look at the names within the portfolio, and very clearly the idea is to identify companies and entities which can execute well irrespective of the environment. What has essentially happened is, because urban has contributed to growth, we've actually seen share of urban for most of these companies in up because rural has been struggling and has not contributed to the volume growth. So it's also a function of that. The second aspect is, from a more structural point of view, we believe urbanization will continue as a theme. You will see people moving out of the rural and coming to the urban pockets. So urbanization is one theme that will play out. And companies which build moats there will very clearly be able to execute both on the volume growth that will happen, plus on the premiumization that can happen on the urban side as well. While urban may be some degree of heavy inclination for these names, there is a fair degree of rural exposure there as well. Our sense is as rural starts to fire, you will see some degree of adjustment that will happen even in the revenue mix itself. So the idea is to identify companies which have the right model, right capital efficiency, right distribution network to execute on ground, irrespective of situation that is there in urban and rural, and can deal with the volatile environment.
Thank you, Chetan. The one of the question which has come on the EOP portfolio, the last 1 year basis, a few stocks like Infosys, the Page, as well as the Patanjali has actually dragged the performance to some extent. So these stocks has been, what is the rationale for that underperformance, and are you taking any action on these stocks?
So I'll start with Infosys. I think Q4 was a disappointing quarter as far as Infosys is concerned. Not only it disappointed our expectation, it also disappointed the street's expectation. We've, for the first time after quite a number of quarters, witnessed a degrowth as far as constant currency growth is concerned for Infosys. The way we are looking at the IT sector in general is that there is a strong proposition of the IT space in the entire digitization transition and transformation that is happening. What is currently happening is obviously because of the volatile macro environment, we are starting to see some degree of a movement in budgets from the companies or customers, clients globally. While some time back, the idea was to spend both on cost optimization and growth initiatives. What we are starting to incrementally hear from IT companies is that most of their clients are now talking about cost optimization to begin with, which essentially means that the growth piece, that money and allocation there starts to move towards cost optimization. And there is some push out of certain already signed deals and contracts that happens. On the positive side, one critical aspect that was hurting performance was the entire supply side issue on IT. What we are starting to see is attrition starts to come down, particularly in terms of churn, and you start to get the benefit of operating leverage as most of the people who were hired recently start to contribute to revenue. So our expectation there is, while dollar revenue growth might moderate, you will probably see some degree of outperformance as far as margins are concerned. From a more medium to long term perspective, I think at the time of COVID, there was a view that dollar growth itself has accelerated significantly and structurally for the next 5 years. Today, the view is that that growth itself will remain tepid for a length of time. Even then and even now, we firmly believe that we will still be somewhere in the middle. They will deliver what they've delivered historically, which is 8 to 10% dollar growth, 10 to 12% kind of earnings growth, where valuations stand today. There is some degree of cushion that is there. Having said that, we are monitoring the situation very closely, and we are also monitoring what is there in our available universe set and whether we can find something which is better, which provides better return compared to what is there in the portfolio. So we are keeping a close eye there. I think IT will still see some degree of pain in the near term because of the volatility in the environment itself. Coming to Page, I think Page, what we are witnessing is obviously, like I've highlighted, first an impact of the tepidness in the volume growth itself, which is visible across pockets, be it rural largely, to some degree in urban as well. Second aspect which has impacted performance is that Page is also going through a period of rejigging their entire internal distribution network, where they want to get inventory days more closer to what they can sell at. So they are essentially implementing a system there, which is leading to some degree of mismatch between what is happening on primary and secondary sales. The expectation there is, as that system gets into place and starts to function normally, you will actually start to again witness primary and secondary being very close to each other. So we are going through this period of that adjustment. Our expectation is it can continue for a quarter or two more after which we will structurally see a lower inventory in that particular company, a lower working capital cycle there, which improves the quality of the business. But as this process happens in the backdrop of a weak demand environment, the pain is essentially a tad bit more compared to if the same exercise would have happened when the environment was more buoyant. But this is what it is. I think they are going through this process now and ensuring that the business utilizes this time of weakness to improve the quality of the business itself structurally. The third name where we've witnessed impact is Patanjali. I think Patanjali, the impact has also been there because Patanjali has two aspects to it. One is the entire edible oil piece. Second is the food business, which got transferred to Patanjali. There has been an impact on the edible oil piece because of a fair degree of volatility on the input prices. What that has meant that we've seen some quarters of inventory write-offs, we've seen some quarters of inventory gain. Our expectation is that as things stand right now, probably from FY24 onwards, you will see a normalized contribution from the edible oil piece, which is essentially providing volatility to the earnings. While the food business will deliver what we expected to deliver structurally, which is 15 to 18% kind of top line growth, a tad bit better bottom line growth, and that is where we believe there is value. Patanjali still continues to remain a company which is executing on getting the processes in line with what we've seen with best-in-class companies such as HULs and Nestle's of the world. So once we see that transition happen, you will actually see earnings volatility reduce there. So we are keeping a very close eye there, but the volatility in 23 was a function of volatility in underlying commodity prices.
Thank you, Chetan. In the EOP portfolio, as recently the quarter earnings has been over, we have observed that in the portfolio like a paints industry, one side Asian Paints has given a growth, but in our Berger has given the negative results. At the same time, the Radco also has given a negative results. The last and the company, which is a Page, that also has given negative results, which has covered it. So these two companies has given negative results. So is it an internal effect on or the external reasons, and what we are acting on these two stocks?
So in case of Radico, to begin with, I think what Radico is witnessing and the entire Alcobev pack has seen in the last 1 year is that there has been a fair degree of inflation on the input cost, be it the ethanol prices or the glass prices that have witnessed inflation. The glass prices have particularly seen inflation because of what has happened to the natural gas price. As we move on to FY24, the expectation is that inflation will be behind us. What we've also seen is they've been able to get price increase on the base product of their portfolio, which starts to kick in from April of this particular year, which is first quarter of 24. We've seen them commission a dual feedstock plant, which essentially provides a backward integration benefit. So all of that put together will start to contribute towards margin expansion, in turn meaning that from here on, we expect operating profit growth to accelerate. From a more structural point of view, what they've got right is essentially the contribution of prestige and above of the portfolio has continued to improve. Despite the inflationary environment that they witnessed, we've actually seen contribution continue to scale up even in FY23. The expectation is that that is a structural thing that will play out from a more long-term perspective. It stands out because of the brands that it has been able to create, something like a Jaisalmer, which is a standout brand which they've created in-house. So they continue to deliver on the prestige and above segment. From a more medium to long-term perspective, our expectation is that the popular segment will still see moderate volume growth in single digits. It is essentially the prestige and above segment, which is the premium segment, which will see higher volume growth. Coupled with this, you will obviously see the benefits which will play through of backward integration and premiumization of the portfolio. So while we were expecting weak performance from Radico, in particularly in FY23 because of these factors, we still believe structurally things remain in place. From FY24 onwards, it's geared for acceleration in earnings growth itself.
Thank you, Chetan. Participants, if you have some more questions, I request you to place it in the Q&A box. Again, the Vipul is asking one more question, which is IEP and EOP as having both the portfolios of him looks like the same, similar to the stocks. So why should I come to the EOP as a top up or to wait for so much of a period of time?
Oh, I think as far as the overlap is concerned, there is close to 65% kind of overlap between these two portfolios. What is to be kept in mind when you're looking at both these portfolios together is the fact that the overlap is essentially coming from one, the large cap weight, which is sitting in an EOP and an IEP are similar, because of which there is some degree of overlap. Apart from that, there are some names on the largest mid cap, which are a part of both the portfolios. So what is differentiating is the balance part of the portfolio. Essentially, as I was touching upon, the idea is as we deploy liquidity or we make changes to this particular portfolio, the idea is to look for names with a mid cap and small cap bias. So the expectation is that you will start to see some degree of opening up of the differentiation between the two portfolios. Very clearly in terms of positioning, IP is a flexi cap product with an underlying theme of Indian entrepreneur ownership. EOP is very clearly a mid cap oriented portfolio. So that is where the differentiation will come from. Apart from that, I think we've also seen over the journey of last 20-25 years is that barring other forms of ownership or underlying patterns, we've actually seen promoters who have skin in the game. They have tend to execute much better from a more medium to long term perspective. And hence EOP also has a fair degree of higher Indian promoter ownership within the portfolio.
Yeah.
So it will essentially be
the
changes that we are making and the names that differ today. So the expectation is each change itself will predominantly should be from mid cap and small cap, barring the fact that if we believe that a large cap name in that particular pocket itself is best placed to capture the opportunity.
Yeah. So a couple of questions keep on coming. We would be taking into the one last question, then Chetan would be summarizing of the things. Today, I think keep off couple of questions is coming. So the last one question, one of the customer is asking that he has invested into the ASK EOP. At the same time period, he has also invested into some of the mutual fund schemes. So those mutual fund schemes has been delivered good return of the double digit, where he could not able to see here. So what's your view on that, Chetan?
So there very clearly, I think what has happened is our underperformance last year is dragging a fair bit of performance of the last few years. The reason for the underperformance of last year is what I've covered in my opening part of the presentation. The fact that the way we are addressing this underperformance is we are looking at names which we believe fit our criteria of high quality, high growth, where we expect them to deliver on the earnings growth. The expectation is that as they continue to deliver and show a superior character in growth, you will see performance that will follow. The underperformance itself is what we are trying to catch up first to begin with. We don't want to take any knee-jerk reactions and changes that we make, which increases the risk component of the portfolio as well. So the idea is to approach the entire transition from a more risk-adjusted basis and sticking to our philosophy of high quality and high. We are seeing some early signs of improvement there. Our expectation is if the portfolio delivers on the earnings growth that we expect the portfolio to deliver, we will see this catch up continuing as we move.
Thank you, Chetan. So overall, all the questions we've been covered, and thanks for giving that the in detail of all the answers. We request you to summary in terms of the UOP, in terms of the customers who will be investing for 2 years, has been the customers who would like to top up and would be the long-term perspective. You can just give us some summary, it will be help us.
Just before that, Suresh, we still have another 5-10 minutes. If there are questions which you believe are still unanswered, we'll be more than happy to answer that right now before I summarize.
Yes, sure. Yes, the most of the questions was in terms of the IOI performance, which has been come, the new stocks. Yeah, the same questions keep on coming. That cousins, you are right. You can go ahead with this one, the summary part, Chetan.
So the way, just to summarize, the way we are looking at things right now is we expect acceleration of earnings growth from an FY 24-25 period onwards. Like I've highlighted, the two risks that we see to delivery of this earnings growth. One is clearly what happens to monsoons and how that plays out, particularly on the rural income side. That will determine how fast volume recovery can happen from a domestic perspective. We see a very favorable base as far as exports are concerned as we move ahead into more medium to long-term perspective. Having said that, I think structurally things are in place for acceleration of growth itself. from a more medium to long-term perspective. It is the near term. We've been touching upon this for a good 6 to 9 months now. It is essentially this near-term muteness in the environment that we have to deal with, which has stemmed from a combination of first increase in cost of capital, which has obviously complicated the demand equation, not only globally, but also to some degree because of this higher inflation from a domestic perspective as well. What did not help us is probably the kind of recovery that we should have seen in FY23 on the rural side itself. So having said that, I think the risks are two, which we are keeping a close eye on. But structurally, from a more medium to long-term perspective, we believe things will accelerate. The idea is, and the idea of doing this call also is that we are able to share with you on how we are seeing earnings performance, particularly in general and for the portfolio as a whole from a more quarter-to-quarter perspective. Q4, in summary, has been tad bit better than what we would have anticipated Q4 to be. Q1, so far, the commentary that we are hearing from most of the managements that we are meeting is that we've still not seen any material change in the volume growth as far as the rural side is concerned, but there is stabilization in the environment. What we are seeing is margins continue to hold on as far as the base of Q4 is concerned sequentially. So that will mean that H2 earning growth will still at least be delivered from more normalization of margins. I think as monsoon progresses, we will get a fair degree of high frequency data that will point towards how volume recovery is happening. From an export perspective, I think structurally India is well poised to capture the opportunity of both import substitution and acceleration of exports. There also, we are seeing some degree of near-term headwind. A large part of the headwind is probably behind us because we've seen fair degree of destocking that has happened across the board. We've seen a lot of pain on the demand side. We should start to see positive contribution in a quarter or two there, starting from there, where we see restocking start. Post which I think the equation will switch to global growth itself in general. And obviously there is a strong tailwind in India's favor. We have a very small market share, and any incremental demand, if a large part of that comes here also, that means a sustained level of growth for the entire manufacturing piece out of India. So I'll just stop there, and I'll thank everyone for joining us in this particular call. If there are still queries and questions which you believe are unanswered, please feel free to reach out to us. I will be more than happy to answer.
Thank you, Chetan. Thank you, participants, for the joining of this call. So we will meet again after the quarter, the quarterly update on the EOP con call. Have a great weekend.
Thank you. Thank you, everyone.
Have a great day.